Hey everyone, and welcome to this explainer. Today, we're decoding one of the absolute most powerful universal truths of the market, and that's how prices constantly alternate between quiet, totally boring consolidation and massive, explosive moves. Honestly, if you've ever felt like the market only makes a run when you look away, or if you constantly find yourself buying at the exact wrong time, you are definitely in the right place. We're going to break down the actual mechanics of volatility, and more importantly, how you can use it to build a serious edge. Let's get started.
Look, we've all been there, right? You see an asset just rocketing higher. Maybe it's Bitcoin or gold on an absolute tear, and that fear of missing out kicks in. You finally hit the buy button. And then, instantly, it reverses and crashes. It is literally the most frustrating feeling in the world. But what if I told you the market actually acts like a giant coiled spring? The secret here isn't in chasing the explosion after it happens. No, the real secret is identifying that quiet, tight coiling phase right before the spring actually releases.
So here is our roadmap to solve this today. We'll start with the volatility cycle, then break down the anatomy of the VCP, move into spotting institutional footprints, lay out a step-by-step trade execution plan, and finally cover managing risk and mindset.
Okay, let's jump straight into Section 1, the volatility cycle, or how the market essentially breathes in and out.
To really understand price movement, you've got to understand implied volatility, or IV. Think of IV as just the market's expectation of future price fluctuations. It's cyclical. When IV is incredibly high and things are chaotic, mean reversion kicks in, and it eventually calms down. But on the flip side, when IV is really low and things are quiet, we can expect a violent expansion. This is exactly what indicators like Bollinger Bands visually map out for us on the chart. You get that super tight squeeze, which is inevitably followed by an explosive release.
So it basically boils down to two distinct phases. Think of it like two sides of a coin. On side A, we have volatility compression. This is when IV is low, the candles are tiny, and the chart looks, well, boring. But beneath the surface, it's actually an energy-building phase. A major squeeze is happening. Then, on side B, we have volatility expansion. This is the massive breakout, the big liquidity release, that highly anticipated phase where IV spikes. The tricky part is knowing exactly when that transition happens, which is why we really need to recognize this cycle to position ourselves perfectly.
Moving right along to Section 2, Anatomy of the VCP, and how we actually visualize this stored energy.
Okay, the volatility contraction pattern, or VCP. This is a truly universal pattern. It was popularized by legendary traders like Mark Minervini, drawing heavily on the methods of icons like Jesse Livermore. Basically, the VCP visually shows us the transition from high volatility to extreme tightness. You'll see an asset make a series of progressively tighter and tighter price consolidations. It's basically the chart's way of visually telling you that supply is completely drying up.
But hey, you don't just have to eyeball it and guess. We have objective tools for this. Metrics like the average true range, or ATR, and relative measured volatility can actually measure this contraction mathematically. By running these indicators through your screening tools, you can easily pinpoint the exact assets that are primed for explosive moves, simply because their volatility has compressed down to critical needlepoint levels.
Which brings us to Section 3, spotting institutional footprints. This is where we get into the real mechanics of supply and demand.
This quote right here is absolutely crucial to internalize. Tight areas on a chart represent institutional accumulation. It's the ultimate insider secret. While the average retail trader is getting bored out of their mind watching a chart chop sideways in some tiny little range, the massive institutions are quietly going to work. They're methodically absorbing all the available supply without driving the price up. They are leaving a footprint. When the price gets incredibly tight, it just means there is literally no one left who wants to sell.
And history proves this over and over. Tech giants like Google and Tesla had their most explosive stock runs directly out of VCP setups. But actually, this isn't just a stock market thing. It applies perfectly to commodities and crypto too. Just think of gold's historic, multi-year breakouts or Bitcoin's massive, tightly coiled consolidations right before a pre-halving parabolic run. All of these are the direct results of big money accumulating during a tight volatility contraction.
All right, let's turn theory into practice with Section 4, Trade Execution, our step-by-step playbook.
Here are your 4 concrete steps. Step 1, identify that tight contraction using your eyes or a screener like ATR. Step 2, accurately mark your key resistance and liquidity zones. Step 3 is the hardest part. Wait for the trigger. You want to see a massive spike in volume or a really powerful push above the view up, which proves that institutions are finally stepping on the gas. And step 4, enter on confirmation. Wait for that breakout candle to close and show actual, undeniable momentum.
Now listen closely, because I cannot stress this enough. Do not enter during the compression phase. I know, it's so tempting to try and front-run the move to maximize your profits, but an asset can consolidate for weeks or even months. Capital tied up in a dead zone is lost opportunity. You have got to wait for the actual expansion trigger to fire off, either the initial breakout confirmation or the subsequent pullback and retest. Patience is 100% your greatest asset here.
Finally, we've got Section 5, Managing Risk and Mindset. This is all about keeping the money you make.
Let's break down the psychology. During a boring market phase, the winning pro is incredibly patient, while the losing amateur gets totally eaten up by FOMO and chases the asset after it's already overextended. For entries, the pro patiently waits for confirmation, while the amateur gets chopped to pieces buying fake breakouts. And critically, when it comes to a stop loss, the pro places a tight stop slightly inside the consolidation zone, while the amateur blindly holds onto a failing trade, just praying for a bounce.
You've got to follow some strict risk management rules to survive. First off, tucking your stop loss just slightly inside that consolidation zone is a lifesaver. Why? Because if the price breaks out but then violently slams back into its old tight range, that was probably a fake liquidity grab. The setup is totally dead and you need to cut it. Size your positions for breakout volatility, ride that expansion until the momentum visibly weakens, and for sure, never, ever chase those extended massive expansion candles.
Remember this rule above all else. When a tight area fails, you manage risk immediately, no hesitation. Even the absolute best-looking setups in the world are going to fail sometimes because of broader market conditions or just some hidden supply wall. But taking small, manageable losses on those fake breakouts, that is the true hallmark of a professional. Capital preservation is the only thing that allows you to come back the next day and retry the exact same setup when the timing is actually right.
And that brings us to the end of our deep dive into the volatility cycle. I really hope you got some value out of this, but before we wrap up, I want to leave you with a quick question to think about. When you spot these coiled springs setting up on a chart, are you the type of trader who prefers the thrill of catching that initial breakout expansion? Or do you prefer to let the dust settle and wait for the retest after the volatility releases? Let that sink in. Thanks so much for joining me on this explainer, and I'll see you on the next one.